It goes back to 2020. Okay, so 5 years. We know in early 2020 into late 2020 and early 21, silver exploded in price. And therefore, the spread chart showing an ounce of silver divided into an ounce of gold was under 1% then. It was under 0.9%. Divide an ounce of silver, an ounce of gold. It shot up to over 1.5%. That's a huge percent gain. It's like buying a stock at under $9 and it goes over 15. Did it in like 6 months. These are weekly readings here, by the way, week to week. But then since 2021, when silver was over 1.5%, which is still dirt cheap historically, silver to gold, it eroded. Now, price of silver is going up since 2020. We know that. 2020 was 30. We're now, $52, 53. So it's gone up, but its performance versus gold has eroded, meaning it's not gone up as much as gold from that point to the current level. Now, you'll notice since about March of this year, that thing exploded back up again.
For several months, the precious metals market has been awaiting definitive confirmation that silver was not merely appreciating, but positioning itself for a significantly more intense and historically consequential movement. And in the view of momentum analyst Michael Oliver, that confirmation has now been established. Oliver cautions that we are approaching the threshold of a new era for silver. This represents not a continuation of the trend observed since 2020, but rather a structural break analogous to the extreme increases of 1980 and 2011. And similar to those periods, the same bullish momentum that fueled silver's most rapid and vigorous rallies is now confronting a 3-year resistance level. His communication is direct. When this spread is breached, silver does not ascend. It erupts. And if you are not already in position, you will forfeit the opportunity to capitalize on the move. Today, we analyze precisely how Oliver recognizes that this moment is approaching and why he believes silver could reach $200 much more rapidly than commonly anticipated.
Shows is gold, ounce of gold, using front month COMEX contract, divided into the S&P price, okay? And you can see back in 2011 through 13, especially in 13, which is where this chart starts, gold was collapsing in price also against the S&P. It was losing value to the S&P. And when gold bottomed in late 2015, that spread reached down to about 50%, that first little circle you see there. And at that point, you can go sideways for 10, 11 years now. And it's been above that level and below that level, but basically par to the S&P. In other words, it's, depending on the point in time you pick, it's doing better or a little bit worse than the S&P, but basically going sideways, okay? Meaning it's not really been as bad as people think. And it's not just recently that gold's firmed. It's at the upper end of the 11-year range right now. But this thing has built a technical base that is so clear it smacks you in the face. It's hit 1, 2, 3, 4 times as of April this year. You bumped that line, backed off again. You're back pressing at it right now. In fact, you're above it intra-month. This is monthly closes. So gold into the S&P. And you close the month where you are now. Divide gold into S&P. It's going to break out. What does that mean? It means that this is a fresh, massive technical base breakout. Treat it as a price chart. If you looked at this and saw it as a price chart, you say, oh boy, I'm going to get on board. And I'm going to buy. Well, this means buy gold, sell S&P. In fact, you want to go market neutral, buy gold, sell S&P. You have to put a spread on. But it's also telling you that gold is going to surge versus the S&P. Now, by the way, when we do this same chart, we didn't have it in this report, versus the Dow, or gold versus the New York Composite, both very broader indexes that aren't front-end loaded with a couple of AI stocks like the S&P is. Gold's already broken out. But when this guy breaks out, this spread breaks out, it's telling you as a major asset class shift is underway, it's commencing. Gold is now going to outperform the S&P. So if you invest over spans of time and want the better asset class, it's saying gold is going to lead the S&P now. It's the better place to be. And our assessment is, one, it's going to be the consequence of two things: gold going up and S&P going down. Okay. So this is our table pounding the technical chart to nail you all. If you're in the stock market or the gold market or wherever you are, this is the most important breakout that's about to occur. And if it breaks out, which it will, this is too persistent, okay? It's saying, I just began. So if you think gold is old, it's just begun its major shift against the paper bubble, the U.S. stock market. Just began. It ain't going to end in 3 months. This is something going on for years. So don't think of gold as being at the end of something. It's just beginning when you measure it versus the U.S. stock market. And again, it's already broken out versus the Dow or the New York Composite. It's about to break out versus the S&P. So this is a very important investment grade technical chart. This only goes back to 2020. Okay, so 5 years. We know in early 2020 into late 2020 and early 21, silver exploded in price. And therefore the spread chart showing an ounce of silver divided into an ounce of gold was under 1% then. It was under 0.9%. Divide an ounce of silver, an ounce of gold. It shot up to over 1.5%. That's a huge percent gain. It's like buying a stock at under $9 and it goes over 15. Did it in like 6 months. These are weekly readings here, by the way, week to week. But then since 2021, when silver was over 1.5%, which is still dirt cheap historically, silver to gold, it eroded. Now price of silver is going up since 2020. We know that. 2020 was 30. We're now, $52, 53. So it's gone up, but its performance versus gold has eroded, meaning it's not gone up as much as gold from that point to the current level. Now you'll notice since about March of this year, that thing exploded back up again. So silver's been outperforming gold for the last half a dozen months or so, gaining. But there's a green line on that top chart, the spread chart. If you can clear that line, this spread breaks out, and that line goes back over 3 years. Ceiling, ceiling, ceiling. It's called what you call a base, okay? You break out over that, it's a fresh buy signal, meaning time to buy silver rather than gold. Doesn't mean gold's going down, just means silver's going to beat it. So if you have the combination of that first chart, gold breaking out versus the S&P, what it's telling you is you want to be in monetary metals, not the stock market bubble. This chart says you not only want to be in monetary metals, you want to be in silver as opposed to gold, because it's going to beat gold. I'm strongly of the assessment that when that first chart breaks out, gold versus S&P, as I said, it's already broken out versus the broader stock market indices. Silver's going to break out versus gold. And already this spread chart doesn't show where it is right now. It's up. It's moving up toward that green line right now. This chart's a week or so old, and we know a lot has happened in the last week. So that's another spread I'd watch, because it's not only telling you monetary metals are a place to be, but now you really want to focus on silver.
Michael Oliver has dedicated decades to analyzing market momentum frameworks and contends that silver is exhibiting one of the rarest and most volatile patterns in contemporary financial history. He indicates a chart that scarcely any mainstream analyst examines, the silver versus gold spread. This spread illustrates the relative performance of silver in comparison to gold and has historically provided early warning signals months prior to silver's most volatile periods. Oliver states plainly, this spread has been exerting pressure against a ceiling that has remained in place for over 3 years. Once it fails, the timer commences. This is not merely a theoretical matter. The previous 2 instances of this spread breaking out occurred in 1979 and 2010, during which silver's movement was not merely marginal. It ascended vertically. In 1979, the breakthrough of the spread occurred 5 months prior to silver reaching $50. Silver increased from approximately $15 to $50, quadrupling in value within just a few months. Between 2010 and 2011, the same outbreak prompted a 150% increase over 7 months, causing silver prices to rise from the teens to nearly $50 once more. Oliver emphasizes that this explosive phase does not occur during the initial years of a bull market. It occurs following an extended period of stability when the spread ultimately breaches its containment zone, prompting purchasers to pan it into genuine monetary assets as paper markets simultaneously lose confidence. And presently, he holds the conviction that the moment is approaching rapidly. Although inflation figures, interest rate expectations, and headlines dominate the news cycle, Oliver asserts that these are not the factors influencing the next move. The primary factor is the failure associated with the era of the central bank. A century-long endeavor in which the Federal Reserve, European Central Bank, and Bank of Japan sought to regulate the supply and value of money as if it were a centrally controlled commodity. That system generated economic cycles characterized by rapid expansions and contractions, unprecedented levels of leverage, unsustainable valuation levels, and fragile financial markets. Currently, consumer concern is increasing, credit delinquencies are mounting, and the stock market is diminishing in momentum despite reaching new highs. That is why the other essential indicator monitored by Oliver, which compares gold to the S&P 500, is currently approaching a potential breakout. This ratio has remained within an 11-year sideways range, but it has approached its upper boundary on 4 separate occasions in recent months and is now trading above it intra-month. According to Oliver, the breakdown of this spread indicates a significant rotation within key asset classes. Gold has consistently outperformed equities over the years, and when gold begins to outperform equities, silver has historically started to outperform gold. The simultaneous occurrence of the two signals, namely gold exceeding the S&P and silver surpassing gold, has only been observed at the outset of the most significant and dynamic silver phases in recorded history. However, Oliver extends his argument further. He states that gold has only reached the midpoint of its potential movement. The two most significant bull markets in recent history, spanning from 1971 to 1980 and from 2001 to 2011, generated returns of 8-fold from their respective lows to peaks. If gold merely reflects that historical trend, it aims for $8,000. And if the international monetary system starts to break down and nations resume gold backing, the figure could reach $20,000 or more. Historically, at these levels, silver has traded at 2 to 4% of the price of gold, indicating that silver would be valued well above $200. And Oliver contends that silver may surpass that threshold as a result of decades of artificial price suppression, criminal manipulation convictions, and a structural disparity between physical supply and investment demand. His position is unequivocal. If you are awaiting a conventional pullback, you remain anchored in an outdated perception. This subsequent action will deviate from standard procedures.
Now, where might it go? If you go back 50 years and measure the peak point of where silver was versus gold each of those years, what was the highest rate, percent level, ounce of silver? 20 of those 50 years, it was at 2%. No, some of those years weren't even bull years. In fact, the bull years, 1980, 2010, 11, silver was up to 3.5% and more, the price of gold. But just routinely, 2% is not uncommon, 20 out of 50 years. Well, heck, right now you're at 1.27% as we speak. If it went to 2%, just a norm, well, that's a huge move. That's almost a doubling of the price of silver in relation to gold. So anyway, this is an area where I'm mostly focused personally in my investments, and they're exposed at the end of each report. I disclaim what I own. All my emphasis is in silver, sometimes silver calls, silver miners.
Yeah, I want to look at the silver ETF versus GDX.
I got it. This,
so,
this sort of reflects what you saw on the silver gold chart. Back in 2020, you had this surge where the silver miners beat the gold miners. It's like buying a stock at about $96 and it goes to 135 in 6 months. The spread went from about 96% to about 135. Divide the price of SIL, the miners ETF, into the price of GDX, which, by the way, does hold some silver miners, but it's primarily gold miners. But since then, Even though SIL and GDX are now above, have advanced, and they're above that 2020 price high, the spread is not, meaning the silver miners have sort of gone sideways on the spread chart back to 2022. I've got a little black line there on the top chart, horizontal line that shows that they've oscillated either side of sideways since 2022. So for 3 years, basically the silver miners haven't really underperformed, but they haven't outperformed. But there's a structure, that green line, that's been hit 4 times since 2022. So it's a clear structure. You close a month out above that green line, and right now we're pushing to do it. The current levels reading of silver versus GDX. Then not only is silver breaking out versus gold, but the silver miners are saying, I'm breaking out versus the gold miners, which would echo what we're arguing is likely to be the case, silver versus gold. So my emphasis among the miners now is to buy silver miners. I think this time around in the major markets of the world, gold being one of them, the monetary metal been around 3,000 years, silver as well, that the ongoing process we've had for about 100 years now, one long human lifetime only, of the Fed, one, have a monopoly control over the quantity of money and a monopoly control over the pricing of money. Okay. Now, if you had that over, let's say, the price of corn, and the government said, okay, corn's essential, we're going to take control of that market, we're going to determine the quantity that's produced every year and the price we're going to sell it at. Well, people would say, well, that's socializing the ag industry. It's what Mao Zedong did. They gave that up in the 1980s in China, by the way, they privatized. But nobody comments on that. It's an inefficient way for the most essential commodity between human beings when they make a transaction, whether they know each other or they're separate parts of the world, to be distorted by a central bank. Well, if that is not causing good effects.
Michael Oliver's caution to investors is unequivocal. The charts are indicating the same signals that preceded each significant silver surge in the modern era. The breakout of gold relative to the S&P, the breakout of silver relative to gold, and the impending breakout in silver miners all indicate the same conclusion. We are nearing a pivotal juncture in monetary policy. If his assessment is accurate, silver is not merely anticipating a rally. It is in the process of preparing for a repricing event, the type of movement that occurs solely when confidence in the financial system erodes and capital shifts back to tangible assets. If you seek more in-depth analysis of this nature, anchored in data rather than bluster or headlines, then please subscribe. We will address every aspect of this unfolding transition, and it is advisable not to be the last to recognize the indication. Inquiry for the viewers. Do you believe the silver to gold spread indicates another 1980 or 2011 scenario, or is this period distinct? Please share your thoughts in the comments below. Your insights could influence our subsequent decisions.